You have money in the stock market, but do you feel like something is off? The charts keep going up, but inflation is surging, interest rates are tightening, and the market seems to be ignoring the chaos. This video is a direct warning. Most investors only realize the danger when they've already lost a large portion of their capital. But today, you'll learn how to recognize the signs before the majority, understand what big investors are watching behind the scenes, and more importantly, how to protect yourself, or even profit, when the majority starts to panic. Have you ever felt like something was wrong in the air, but no one was talking about it? As if the market was walking a tightrope on the verge of snapping? While everyone pretends everything is fine, the data tells a different story. The stock market might look strong, but the warning signs are becoming more and more obvious. And in this video, I'll show you how to spot those signals before most people do, and more importantly, how to protect yourself, or even profit, when chaos begins. If you're tired of reacting too late, this video will change the way you invest. So hit the like button now before you forget, and subscribe to the channel if you want to keep getting alerts like this firsthand. Most people only realize a crisis has arrived when they're already in the middle of it. In 2008, the news spent weeks downplaying the risks before the collapse. In 2020, the optimism continued right up until the moment the market crashed. And in 2022, many ignored the impact of rising interest rates until their portfolios were bleeding. The point is, the signs were all there, but most people chose not to see them. And the price of that blindness was high. This happens because a lot of people enter the stock market without truly understanding what drives it. And when fear hits, they sell at the worst possible moment. But you don't have to be another one in that statistic. Hit like if you want to be among those who act early, not those who chase after losses. Every economic collapse leaves traces. There's no bubble that bursts without first showing signs. The problem is those signs rarely make the headlines. They're in the inflation data that keeps climbing, in the interest rates squeezing credit, in company valuations more stretched than ever. Companies with no profits being traded as if they were money-printing machines. Central banks slamming the brakes harder than we've seen since the 1980s. And yet, the average investor keeps buying stocks as if the market will rise forever. If you've been through that, or know someone who got caught off guard, share this video. It might open a lot of eyes. What's happening in the market today isn't just a random scare. These are consistent signs that we're in a danger zone. The S&P 500 is being traded at a P/E ratio above its historical average. Inflation remains high, even with elevated interest rates. And the Federal Reserve has made it clear, it's not cutting rates anytime soon. Meanwhile, investors are in denial, betting the party will go on. But if history teaches us anything, it's that parties like this end painfully. And those who spot the signs early can leave the dance floor before the music stops. Subscribe now if you want to learn how to exit before the crowd. Now let's talk about an invisible enemy, your own brain. Most investors lose money not because the market went down, but because they made decisions driven by emotion. Confirmation bias makes you search only for information that supports what you already want to believe. Herd behavior makes you follow others without understanding why. And the fear of missing out, the infamous FOMO, makes you buy at the top. Big investors don't play that game. They follow data, not headlines. Strategy, not emotion. That's what separates those who preserve capital from those who panic. Like this video if you've realized that managing your emotions is just as important as analyzing a chart. Now that you understand the risks, let's talk solutions. There are ways to protect yourself, and even profit, during a crisis. The first is diversifying into defensive assets. Gold, dollars, and fixed income bonds tend to rise when the market panics. The second is portfolio rebalancing. Adjusting your exposure during market highs can save you when the drop comes. And the third involves protection tools like puts, inverse ETFs, and stablecoins, which help preserve your wealth even on the worst days. These aren't magical strategies. They're methods used by those who understand the market moves in cycles. And those who prepare, survive. Drop a comment below. Do you already use any of these strategies? Let's look at some real examples. Michael Burry saw the housing bubble before anyone else. He was mocked, but made billions when the market flipped. Stanley Druckenmiller, across various crises, bet against the market based on data and foresight. These guys don't have crystal balls. They just learned to recognize the patterns before it was too late. And more importantly, they trusted the analysis, even when they were alone. What these cases show is that anticipating isn't about predicting the future, it's about seeing the present clearly. And if you're watching this far, it's because you want clarity too. So drop a like if this content makes sense to you. But even with all the information in the world, there's one part few people talk about: mental preparation. When the market collapses and everything seems to fall apart, your mindset will dictate your decisions. That's when many sell at the bottom and buy at the top. Being mentally prepared means having a plan, sticking to that plan, and not being led by emotion in the heat of the moment. If you've ever been there, you know how hard it is to stay calm when your portfolio is bleeding. But that's exactly when the greatest opportunities appear. Great fortunes aren't made in bull markets. They're built during crises, by those who were ready. We've reached the decisive point. The difference between those who lose everything and those who thrive in chaos is the ability to recognize the signs, act with strategy, and keep their mindset steady. The market won't warn you before it crashes, but the data will. And now you know what to look for. Even the most promising markets hide silent threats. When everything feels calm, that's often when the risks are most dangerous. The investor who only sees green numbers might be ignoring indicators that are already screaming warnings. Small shifts in interest rates, subtle movements in specific sectors, or even a slight drop in consumer activity could be the first signs of a reversal. And that's where the edge comes in. Those who learn to hear the whisper of the data before it becomes a headline can position themselves in advance and drastically reduce the damage from a downturn. One strategy that many ignore is tracking institutional volume. While most focus on financial influencers or social media posts, the big funds and investment banks are quietly changing their positions. Tracking institutional flow helps identify where the smart money is going. If fund managers are moving toward fixed income, commodities, or even cash, there's a reason. Reading the backstage behavior is like a map for anyone who wants to anticipate the next wave of volatility. Market narratives are like collective hypnosis. Sometimes the story everyone is repeating becomes so strong that no one questions it anymore. This time it's different. Tech will never crash again. Central banks will always save us. All of these phrases have been said before historic crashes. Recognizing when the narrative starts to drift from reality is a vital skill. After all, the truth of the market is in the data, not the speeches. And when discourse outweighs fundamentals, the alarm needs to be sounded immediately. Economic cycle studies offer a macro view of how markets behave. Every expansion and contraction phase follows patterns. Knowing where we are in that cycle is like having a financial GPS. If credit is tightening, industrial production is slowing, and unemployment is rising, the stock market is usually next to feel the impact. Many lose money because they act like we're in a growth phase, when we've actually entered stagnation. Understanding the cycle is essential to align expectations and actions. The importance of liquidity in uncertain times is often overlooked. Having part of your capital outside of risk is a strategic advantage. It gives you flexibility. When assets are falling, those with liquidity can seize opportunities with far more bargaining power. Plus, not being 100% invested reduces psychological pressure and prevents rushed decisions. In a climate of uncertainty, liquidity is more valuable than returns. Technical overbought signals are a measurable red flag. Indicators like RSI, Relative Strength Index, MACD, and Bollinger Bands show when an asset is overpriced relative to its historical average. When these indicators all trigger together, it's a sign that a correction might be near. Learning to read these metrics clearly puts the investor ahead of the crowd, which still buys out of hype and follows the herd. Monetary policies that are aggressive usually precede sharp moves in the markets. When central banks signal interest rate hikes to control inflation, it directly impacts the value of risk assets. Capital begins to migrate towards safer instruments, like government bonds, which reduces the liquidity of stock exchanges. Investors who are attentive to these changes can anticipate them by adjusting their portfolios before the market prices in these decisions. And those who act first protect themselves better. Diversifying is more than just having various assets. It's having assets that react differently to the same events. In times of market stress, correlated assets fall together. A portfolio with negative correlation between assets significantly reduces risk. By including gold, foreign currencies, real estate investment trusts from defensive sectors, and fixed income, the investor creates a more resilient ecosystem. Smart diversification is an insurance against the unpredictable. Intersectoral analysis is also a powerful tool for detecting cycle changes. When sectors that traditionally lead rallies, like technology, start to lose strength while defensive sectors, like energy or food, gain prominence, we are facing a route of change. This kind of shift usually isn't fast, but those who identify the first signs can adjust their portfolios gradually, reducing risks and taking advantage of better entry points. Finally, it is important to understand that the market is not there to please your expectations. It is sovereign, sometimes irrational, but unforgiving to those who ignore the signals. The humility to recognize that you may be wrong is one of the greatest weapons of the intelligent investor. In moments of exuberance, the ego causes many to ignore reality. But those who develop an analytical and disciplined mind can weather market storms with more stability. In the end, surviving well is better than always trying to win. Imagine losing billions and still coming out as a winner. This is the story of Howard Marks, co-founder of Oaktree Capital Management, one of the largest risk asset investment funds in the world. And it's not just because he got rich. It's because he knew exactly when to stop, when to buy, and most importantly, when everyone else was wrong. Howard began gaining prominence in the market during the crises of the 1990s, but it was in 2008 that his name became synonymous with investment wisdom. While the world was anesthetized by the real estate market bubble and promises of eternal profits, Marks saw something else: overvalued assets, ignored fundamentals, and a financial system on the brink of collapse. Unlike most, who were seeking quick returns, he focused on capital preservation. He drastically reduced his exposure to risk before the collapse of Lehman Brothers, months before the crisis exploded. But the most impressive part wasn't just that he got out beforehand. It was what he did after everything fell apart. When the markets were plunged into panic, and no one wanted to even hear about stocks or bad credit, Howard Marks was buying. He knew that prices were absurdly discounted, and that fear had replaced logic. The result? In 2009, Oaktree made some of its most profitable investments in its history, buying assets at liquidation prices and positioning itself for the new cycle. Howard always emphasizes that the most important thing is not predicting the future, but understanding where we are in the cycle. He writes memos read by billionaires like Warren Buffett, who has already stated, "When I see that Howard has written something, I stop everything to read it." Today, he remains active, always warning against excessive optimism and market euphoria. And the best part, he never positions himself with arrogance. He always says, "The secret is to be cautious when others are greedy, and brave when everyone is scared." Howard Marks is not just a successful investor. He is living proof that understanding the signals and acting at the right moment is not a gift, it's a method. And anyone willing to learn from history can copy part of this strategy. So the question remains, will you wait for it to fall, or will you prepare today? If you want to keep receiving this kind of content directly, with real alerts and practical strategies, subscribe to the channel now and turn on the notification bell. And of course, share this video with someone who needs to open their eyes before it's too late.